Welcome to the online classroom for the module INV2601 Investment Management. This module is an introduction to the investment management modules offered by UNISA, and it's a second level module. And it's I would say a prerequisite or an introduction to INV2701 equity asset valuation, INV2702 fixed income asset valuation, and INV3703 derivatives. So if you're going to study any of those investment management modules later on, this particular module will be a really important introduction to some of the important concepts you are going to come across. Okay, so a brief introduction, sort of like an orientation before I get into the actual module. You'll notice that the actual module, right, is divided into a number of study units. In particular, you have topic 1, which consists of 5 study units, topic 2, which consists of 4 learning units, and topic 3, which consists of 2 learning units, topic 4, which consists of 3, and then topic 5, which consists of 1. Now, fortunately for this module, right, you'll notice that it's got a lot of material. Basically, what you're doing with this module, you're covering this whole prescribed textbook, and it's a big prescribed textbook. And in total, I think it has 676 pages, right? It's a really big textbook, prescribed textbook. But the nice thing about this module, there are certain key areas you need to focus on to help you with these 3 modules I told you about earlier. There are certain areas you need to focus on to help you with these 3 modules, right? As an orientation to these 3 modules if you're going to do investments later on. And then there are also certain areas you also need to make sure you're familiar with for the INV2601 exam. As big as the book is, fortunately, not all of the concepts, not everything in this book is examined. Not every single thing is examined. There are just certain important things you need to make sure you are familiar with, which will be examined. So based on my years of experience, semesters and semesters of assisting students with this module, I am going to be guiding you through the important things you need to know with regards to the exam, right? What you really need to know. And then if you want to read around what I've told you, you should know for the exam, if you want to read around that, just to improve your understanding, you're also free to do that. But remember, we operate in life where time is an important resource. You don't always have time to go through every single detail. Rather, you want to focus on what's important, what will be a good foundation for the later INV modules, and also what will be good for you to be able to pass this module. And then if there are certain areas I tell you this part is not too important for the exam, if you still want to read it and you have time, you are welcome to go through that at your own time. So I'm going to be focusing on what's important, right? So in this class, I'm going to start by looking at chapter 1, which is titled The Investment Setting. In your prescribed textbook, that would be Learning Unit 1 under topic 1. So you'll find the investment setting in the first chapter of your prescribed textbook, right? And then there are certain important things, like I said before, that you really have to know with regards to the exam when it comes to chapter 1. The investment setting. There are some important things you need to note. So what I'll be taking you through those important things and describing them as we cover chapter 1, which consists of a number of sections. So we're going to be going through this, and I'll be telling you what you really need to know for the exam, what's important, and what you should remember and make sure you are familiar with. It's not too much of a long chapter, and it consists of a lot of information, but there are certain things that come up time and time again in this particular chapter in the exam and in the assignment. So I'm going to be focusing on that for this class and telling you how to approach certain questions. There are certain things that are not as important as some of the other things. So I'm just going to be focusing on the really important aspects that you need to know. If I believe that something is not as important as the other items based on what I've seen historically coming up in assignments and in exams, I will also let you know. Okay, so we can now get started with chapter 1, the investment setting. So chapter 1, the first and most important thing you need to note with regards to the first chapter in this module, and in fact in this module in general, is the concept to do with the risk and return. Risk and return is a really important concept in this module and in any other module, right? So you need to remember that investors have what we call a required return. When investors put money into any investment or they purchase anything for investment, they have what we call a required return. And a simple definition of the required return, it's the minimum return that investors require, that investors require for taking on the risk from an investment. So the prescribed textbook also defines the required return as the minimum return that investors require for deferring consumption of their money, right? That's a bit of a complicated definition, but I think an easier definition is that if we're talking about an investor's required return, we're talking about the minimum return that an investor requires for taking on risk when it comes to an investment, right? So there's also an important concept I'm sure you've come across before, and that concept says the higher the risk of an investment, the higher the required return of an investor. So the riskier an investment is, the higher the return an investor would require for taking on the risk associated with that investment. So that's the first important thing you need to note with regards to this module. And then the second most important thing, in fact, not the second most important, but the second thing you need to note is that when it comes to those returns that we're talking about, those required returns that investors require, we can break down that required return into what we call the real rate of return, or the real required rate of return, or the nominal required rate of return, right? So we can also break down the required return into what we call the real rate of return, or the nominal rate of return. So this is important. This comes up a lot in assignments and a lot in exams. So the nominal rate of interest, right? Remember, an interest rate is the return that debt holders, people who lend money to a company, or even investors, we can say the nominal rate of interest or the nominal required return is the same thing. The nominal rate of interest is the interest quoted in banks and in the general market, right? And then we also have what we call the real rate. The real rate of interest is the actual interest rate you earn after factoring in the effects of inflation. So let's briefly explain these two concepts, right? So if I'm an investor and I go to the bank and I want to invest my money in the bank, or if I'm an investor and I go to put my money in a certain investment, and I'm told that if you invest your money with this investment, right, you are going to get a certain return, right? Let's say maybe I'm told that I'm going to get a 20% return on my money. And let's say this is also the return I required, and then it's the return I've been told I will get, right? So this return, we call that the nominal rate of return, right? It's the return that you are quoted or you are told about when you go to the bank or when you go into the market. When we're just talking in everyday terms, this is the rate of return we're referring to. But we have inflation. Like inflation erodes the purchasing power of money, right? We have inflation. So even if you are earning 20% interest, you've been told you'll be earning 20% interest, part of that 20% interest is going to get eroded or reduced because of inflation, right? Inflation is going to eat away at the purchasing power of part of this return that you're going to get. So after accounting the effects of inflation, right? After accounting the effects of inflation and after removing the effects of inflation from this. In fact, let's rather say after adding the effects of inflation, like after considering the effects of inflation, what's the actual rate you're going to be left with, right? After including the effects of inflation, what are you actually going to earn? What's actually going to be your rate of return? So once we factor in inflation and the reduction in purchasing power of our money, the return that we get is known as the real rate of return, and it's always less than the nominal rate of return. So for example, a bank or an investment might say, we can give you 20% return on your money, but after you take inflation into account and the erosion of purchasing power of money, you might find that you actually only end up with an actual return of 12%. So it means that maybe 8% of the funds have been eaten away by inflation, right? So this amount that you have left after factoring in inflation, after accounting for inflation, this rate of return that you have left after accounting for inflation and factoring in inflation is known as the real rate of return. This is what you really earned after we factored in the effects of inflation, right? So the prescribed textbook defines the nominal rate of return of interest as the interest rate. Okay, this is actually my own definition, but you'll find it in other texts. The nominal rate of interest is the interest rate quoted in banks and in the general market, whereas the real rate of interest is the actual interest rate you earn after factoring in the inflation effects of inflation. So inflation reduces the purchasing power of money, and this is factored in the real rate of return. So we can just compare my definition, of course, with how the prescribed textbook talks about it. I try to stick as closely as possible to the prescribed textbook, but I also try to put it in a simple explanation that won't confuse you too much. So in the prescribed textbook, they do talk about the nominal rates of return. Here we go. They talk about it here. They talk about the risk-free rate of return. Don't worry about that, right? Okay, let's come here. Yeah, the real rate of return, expected inflation, nominal. Yeah, let's actually look at it this way. So here they say that the rate of inflation influences a country's nominal rates of interest. Inflation causes a decrease in the purchasing power of a monetary unit, such as the South African rand. Two factors influence the nominal risk-free rate. So in this case, rather than separating the real rate of return and the nominal rate of return, they go on to say the nominal risk-free rate of return and the nominal real rate of return, the nominal risk-free rate of return and the real risk-free rate of return, right? So in this case, the rates of return being referred to are actually risk-free rates. So when we talk about risk-free rates, we're just talking about the rates that that governments pay when they borrow, like the interest rate that governments pay when they borrow. Like, you know, a government is assumed to be, we assume governments to be risk-free borrowers, right? In a lot of countries, if the government borrows, we assume that the government will always pay back what they owe. So we say that governments are risk-free borrowers. So if you invest in government bonds, right, the government will give you a certain return the government will give you a certain return on your investment in government bonds, and we call that the nominal. We call that the nominal risk-free rate of interest, right? If it's now the government, we add the risk-free part. We call that the nominal risk-free rate of interest. And then after factoring in inflation, even though the government is paying you a certain return on your investments, after factoring in the effects of inflation, we call that the real risk-free rate of interest. So the only difference between the explanation I gave you before and what I'm telling you now is that if it's now the government that you're investing in, not a bank, but rather the government that's borrowing your money in the form of government bonds, we call it the nominal risk-free rate. And then if it's now the government that has borrowed your money, you've invested in government bonds, and we factored in inflation, we call the return that you earn the real risk-free rate of interest, right, after factoring in inflation. And inflation reduces the purchasing power of money. So that's what we're just being told right here, right? So that's an important distinction. I hope you follow that. So now let's actually talk about this nominal risk-free rate and this real risk-free rate. Now let's assume we're now looking at the government exclusively. We're investing in the government. We're investing in government bonds. And we're factoring in the effects of inflation on government bonds and everything, right? Let's actually see how we can calculate the nominal risk-free rate and the real risk-free rate. Let's say we've been given the nominal risk-free rate and we want to get the real risk-free rate after factoring in inflation. How do we do that? And vice versa. Let's say we've been given the real risk-free rate and we want to get the nominal risk-free rate. How do we actually do calculations to get those rates of return, right? Assuming we are dealing with government investments. So we're just going to discuss this briefly, and then we will also look at a simple example and finish off that before we move on to the next section. So on the screen right here, as you can see, we have the relationship between the nominal risk-free rate of return and the real risk-free rate of return, right? And the relationship between those two is that the nominal risk-free rate of return is equals to 1 plus the real risk-free rate of return multiplied by 1 plus the expected inflation. Then we subtract 1 times 100, right? So this is a really important formula. This formula tells us how to calculate the nominal risk-free rate of return if we've been given the real risk-free rate of return and the expected inflation. And then they are all in decimals, right? And then alternatively, we might want to calculate the real risk-free rate of return. We might want to calculate the real risk-free rate of return. And to calculate that, we can say 1 plus the nominal risk-free risk-free rate of return divided by 1 plus expected inflation minus 1 times 100%. And then that will give us the real risk-free rate of return. So we can look at a simple example to illustrate that calculation. So let's say you get the following question. Assume that the real risk-free rate of return is 3% and the expected inflation rate is 5%. Calculate the nominal risk-free rate of return. We simply say 1 plus the real rate of return, right, in brackets, 1 plus 0.03 multiplied by 1 plus 0.005 in brackets. We remember the brackets are important. We subtract 1, multiply by 100% to get it as a percentage, and then we get 8.15%. So the key is to do this calculation slowly and carefully, and you'll get the answer. Alternatively, we can also get the nominal rate of return and the expected inflation rate. And we can do that by saying 1 plus the nominal risk-free rate of return over 1 plus the inflation minus 1 times 100. So you can just practice these calculations with your calculator, put the recording on pause if you want to, just try to enter these numbers into your calculator and try to see if you can get the answers. It's good practice so that you are really familiar with your calculator, right? And then what can happen is we can actually then account for other risks. We can then account for other risks. After calculating the nominal risk-free rate of return. We can account for business risk, financial risk, liquidity risk, market risk, political risk, callability risk, convertibility risk. And basically, the way we can do this is once we have the nominal risk-free rate of return, right? Remember, we assume that the government is a risk-free borrower, right? Once we have the nominal risk-free rate of return, if we are now dealing with another borrower who has business risk, we can add a certain percentage to the nominal risk-free rate of return to account for business risk. Maybe let's say we require an extra 1% for business risk. And let's say the other borrower, the one we're investing our money or the investment as financial risk, we can also add what we call a risk premium for financial risk. Maybe we'll add another 2% on the nominal risk-free rate of return. So we can keep adding risk premiums for all the types of risks that we have. And you might find if the nominal risk-free rate of return was 8%, we can add 1% maybe for business risk, and maybe 2% for liquidity risk, and then we can end up with maybe an 11% required return. Okay, so we can start with the nominal risk-free rate of return calculation, and then we can add risk premiums for other risks. But this is not something that's really asked in assignments or in the exam or something you really need to know, but it's something important for you to understand for your studies. What's more important in terms of getting questions in exams and assignments is this calculation of the real risk-free rate of return and the nominal risk-free rate of return, and how to do these two calculations. So please make sure you understand this. Next, we can look at measuring historical returns. So far, we have been looking at the returns we require, right? We've been looking at required returns, and we're going to continue looking at these later on. We'll look at what we call the capital asset pricing model, also used to calculate required returns, and the arbitrage pricing theory, right? But we now want to move forward to talk about historical returns. So let's say we've had an investment and we've held the investment, let's say for a year or for 2 years, and we want to measure the returns that the investment gave us, like the historical returns of that investment. I'm just going to briefly explain how we can calculate the historical returns for a particular investment, right? So when we talk about returns, historical returns, we are basically talking about when an investor holds an investment and they get returns on an investment historically, their returns can come from two sources. The returns can come from cash flows, or the returns can come from capital appreciation or loss, right, resulting from the investment. So what do we mean by that? If you purchase shares in a particular company, and you want to measure the returns that you got historically, your returns from holding shares can come from two sources. The returns can either come from dividends, right? You can get a share of the profits in the company. We call those dividends. So those are the cash flows we're referring about. Or your returns can also come from capital appreciation. And by capital appreciation, we mean that the prices of the shares you're holding go up. Like if the prices of the shares you're holding in a particular company go up, we call that capital appreciation, right? So if you purchase shares in a particular company You can get returns from two sources, either cash flows in the form of dividends or capital appreciation in the prices of the shares going up. Likewise, if you hold bonds, like let's say you lend money to a company or to the government, you can get interest payments, coupon payments, which are a form of cash flows from your bond investment. And also the price of the bonds can go up, which is also capital appreciation, and then you can sell the bonds at a higher price. Even if you purchase a house to rent out, you can get a return from two sources: cash flow in the form of rent, capital appreciation in the form of the price of the house going up, and then you can sell the house at a higher price. So with any investment, historical returns can be broken down into two parts: historical returns from cash flows or historical returns from capital appreciation, right? So when it comes to these historical returns we're referring to, we can calculate these historical returns using what we call the holding period return, HPR, and the holding period yield, HPY. Now, these two are really important and they come up a lot in the exam. And I'm just going to take you through a simple question illustrating how to calculate each of these. You can also calculate the HPY using your financial calculator. So I'm also going to explain how you can do that. And then we'll move on to calculations on expected returns and standard deviations and so forth. So let's look at an example of how to calculate the holding period yield. So we're told, let's assume that you invested 1,000 Rand at the beginning of the year. So, and then let's say that was in 2021, beginning of the year, for example, or even let's just say 2021, beginning of the year. And then let's say at the end of 2021, you received 1,120. And then let's assume that you want to calculate what your holding period return is. To do this calculation, it's really, really simple. We simply take the ending value of our investment over the beginning value of our investment, and then that gives us 1.12, right? So that gives us 1.12. So we call that the holding period return. So if that value is greater than 1, it means that the value of your wealth went up, and if it's less than 1, it means that the value of your wealth went down. So in order to express the rate of return in percentage terms on an annual basis, yeah, so this investment, this example that I did is a simple one because our investment was for 1 year, right? It was just a 1-year investment. But sometimes, your investment is actually not a 1-year investment. For example, it could be a 3-year investment, right? So even if it's a 3-year investment and so forth, we will say it's a holding period return over 3 years. Okay, so that's important. But we can go further and we can convert the holding period return into what we call the holding period yield, right? So in order to express the rate of return in a percent, let's say we want this holding period return as a percentage, we can change it to a holding period yield. And to change a holding period return to a holding period yield, if it's an investment for 1 year, let's say we have a 1-year holding period return, and we want to change that 1-year holding period return into a holding period yield, we simply subtract 1. The important thing here is if it's a 1-year investment. If we have a 1-year investment, right, and we've calculated the holding period return, and we want to convert that holding period return into holding period yield, if it's a 1-year investment, we simply take the holding period yield, the holding period return minus 1, and then that gives us the holding period yield. So that's important. So for our example, we would just subtract 1, and then we would get 12%. However, if we are now dealing with an investment for a number of years, for example, let's say it's a 3-year or a 4-year or a 5-year investment, the calculation becomes a bit trickier, right? The holding period return calculation will still be the same. Don't worry, I'm going to show you an example. The holding period return calculation will still be the same. It's simply the ending value of the investment divided by the beginning value of the investment. However, the annual HPR, we will have to calculate an annual HPR. So we will start with a 3-year HPR, and then we'll need to convert that 3-year HPR into an annual HPR, where n is the number of years, and we can use this relationship. Annual HPR is equal to the HPR to the power 1 over n. Let me just double check that. Do they not say, and the annual HPR is actually just the annual holding period yield. I just want to confirm that part. Yeah, there we go. Yeah, so the annual HPR will just be, the annual HPR will just be the 3-year HPR to the power 1 over n, where n is the number of years. And then we can calculate the annual holding period yield. We can also then calculate the annual holding period yield by simply saying the annual HPR minus 1. Okay. But we can also do that calculation using the financial calculator. Sorry if it's sounding a bit confusing. I'm going to show you a nice example to explain all of that. We can also use a financial calculator to help us to get the annual HPY. I need to correct this. This should say annual HPY. Let me fix it now. Yeah, the calculator can help us to calculate the annual HPY as illustrated. We just take the ending value of the investment as the future value on our financial calculator. We take the beginning value of the investment as the present value. Our number of years is n, and then the interest will be our annual holding period yield. So just to help us to better grasp that and to understand everything we've been talking about, let's look at a really simple example. So assume an investment costs 1,000 Rand and is worth 1,450 after 3 years. We've been told the holding period return is 1.45. So that's the 3-year holding period return. We simply take the ending value of the investment divided by the beginning value of the investment. That gives us the holding period return. And then we can get the annual holding period return by just taking the 3-year holding period return to the power 1 over 3, right? And then that gives us 1.1319. So that's the annual HPR. Okay, so someone might ask, how do I get the power button on my financial calculator? Like how do I actually do that calculation? So I'm just going to put a scientific calculator up on the screen, and then I am going to show you how to enter that information. So I'm just opening the calculator here, and then I'm going to show you how to actually enter that data, just so you become more familiar with how to enter these things into your calculator. So as you can see on the screen, I've put the calculator. So we would say 1.45. In fact, don't worry about this. 1.45, and then we would say to the power. So you can find a button like this, X, Y, or for some calculators, it's a Y with an X at the top. Either it's X, Y, or Y, X. We can press this. Then we can say, open bracket, 1 divided by 3, 1 over 3, and then equal to, we get 1.13185. You see, that's how we got that answer. And then we can then subtract 1, and then that gives us the annual holding period yield. Of course, we can also use the financial calculator. With your financial calculator, you just make sure you've cleared your financial calculator. You put the ending value 1450 as your future value. 1,000, the present value is put as a negative. You put 3 as the number of periods, and then you press 1 over YR. So with the financial calculator, there's going to be a whole chapter later on which we're going to be looking at the financial calculator. So I'm going to take you through the time value of money, Don't worry about that for now. It's going to be in chapter 4. We're going to use the financial calculator to do a lot of questions. That's when I'm going to spend time on the financial calculator. So I hope you are familiar with your financial calculator, but if you're not, we will talk about the financial calculator there and how to do the calculations, okay? So we've talked about how to measure historical returns. Next, you also have to be familiar with how to measure risk of a single asset. And the risk of a single asset may be measured by the expected return. So it may be measured by the standard deviation and the coefficient of variation. So we're going to talk about that. We're also going to talk about how to calculate the expected return on an investment. And then after that, we'll talk about the coefficient of variation, diversification, unit trusts and hedge funds, and then the investment policy statement. Okay, so I think just to make things a bit easier and to give you an opportunity to just grasp what we've been going through, I'm going to include the rest of the topic in a second class. In the second class, part 2 of chapter 1, I'm going to take you through these examples, how to do them and what they're all about. Okay, so for the first class and first lesson, I think we can end there. We've covered some quite substantial amount of information, okay? So thank you very much for listening to the class. I hope it's been helpful. As usual, if you have any questions or queries with regards to anything covered in this class, please feel free to let me know. I won't always be able to get back to you promptly, but I'll try to do so as soon as I can. Thank you very much.